Welcome back to the Wealth Builder podcast. I'm your host, Nick Donato, financial advisor at Guidance Financial. The 2026 budget has now been released, and it's been called an ambitious budget with big reforms to tax and big changes to structures and rules that have been in place for a long while. The first thing to note is these are still all proposals. They haven't been legislated as yet. So there could still be changes that occur, fine tuning of details around, the tax changes that have been proposed. And, in the media, in the public, there's lots of different opinions when it comes to, the changes to capital gains tax, the changes to negative gearing, how this might affect the property market, and how this affects the broader economy. Today, I'm here to put opinion aside. I'm here to take you through the changes and how they may affect you. We're going to get rid of the jargon. I'm going to take you through the changes to the tax system and explain it to you, hopefully in an easy way for you guys to digest. So, off the top of the budget, one of the changes that will help people's tax payable and the amount of tax you pay is they're bringing in some tax offsets. First one that was announced was a $250 ongoing tax offset for all working Australians. So from 2027-2028 financial year, so in a couple of financial years' time, you'll be able to benefit from this $250 tax offset. Now, we won't see this in our pocket until earliest July 2028 because we've got to do our tax return and be able to claim this $250 tax offset. And it's only for wage earners. So retirees, early retirees won't benefit from this $250 tax offset. The second offset or instant tax deduction that's been brought in is there's a $1,000 instant tax deduction for work expenses. So again, this one comes in earlier, so it's from July 2026. And ultimately it means that you won't need to claim individual items. So you can just do a blanket $1,000 deduction for any work expenses. Now, the one thing to note and not get caught out on is that if we have expenses over the $1,000, we'll still need to record them. We'll still need to claim them in their individual items. So make sure that we are still keeping a record of those. And your accountant can help you classify them and work through that as well if need be. Ultimately, these changes and what they said in the budget was that, on average, someone earning $81,000 will be $2,701 better off compared to 2023-2024. So a bit of a tax savings there for working Australians. One of the biggest reforms or biggest proposed changes within this budget was around capital gains tax. Me and David did a podcast on capital gains tax. It was episode 3 or 4 of the Wealth Builder podcast. You can have a listen to that, but a lot of that is now is proposed to be made redundant. So currently there's a 50% discount rule that was in play. So you hold the asset for longer than 12 months and you get to reduce your capital gain by 50%. So for argument's sake, we bought an investment for $100,000 in 2024. We've now sold it today in 2026 for $200,000. We've owned it for longer than 12 months. our capital gain is 100,000, so the difference. Current rules is we get to halve that, and then that $50,000 gets added to our assessable income for the year. And we pay tax on that. That method is now being replaced by an inflation linked method. And it becomes a bit more difficult to calculate what our cost base is, and what our capital gain is at the end of the day when we sell our assets. But ultimately, what it is we take our cost base, or what we purchased the asset for, and then we inflate that by inflation or CPI until the day we sold the asset. So they're trying to tax us on the real gains made from the investment rather than benefiting from this 50% discount. So we, again, same scenario, same example. We bought the asset for $100,000 in 2024. We've sold it in today for $200,000. With inflation, that $100,000 is worth, call it $105,000. And then the difference between the 105, because we've inflated the cost base or the price by inflation. So the sale price of 200 is $95,000. And then we pay tax on that $95,000. Now, again, it can be difficult to calculate, and we will have a calculator on our guidance website in our resources page that can help you calculate what your new cost base is. The benefit is, or the thing to think about is, we've actually got until 1 July 2027 until that happens. So any gains made from 1 July 2027 takes on this new method. And it's not just property. So there's been a lot of talk around, this being affecting property investors. But from what, I can see, or from what we can see here, is that this affects all investments: shares, managed funds, exchange traded funds. So it's going to have a major effect on, not just the property investors out there. The other one on that is, rather than that gain simply being added to your assessable income for the year, there's actually a 30% minimum tax rate for all gains. So if the plan was to sell during a low income year, say you're on maternity leave, you're taking a sabbatical, you're retired early, and you were planning to sell that asset so we could claim the tax-free threshold and reduce the amount of capital gains tax that we are paying on the investment, that doesn't really work anymore because of that minimum 30% tax rate. So there's that minimum percent, and then it tiers up as per our current tax system with the sliding scale style tax payment. The only exemption is for pensioners or those on income support payments. They don't need to pay the minimum 30%. Rather, it gets added to their assessable income at the end of the year. And again, this is all proposed, not legislated yet. Who knows where we'll actually end up with these rules? There's been a lot of opposition against it, but it's just a wait and see, and that's what has been proposed. The only other thing to note on capital gains tax is superannuation and pension accounts. In super, we do pay capital gains tax, and the ruling or how we pay tax within that structure has remained unchanged. The other big reform that was proposed within the budget, and again, this one is property specific, and we've read through the budget, and it can be a bit vague at time, but this is property specific, is that negative gearing is no longer a thing for new purchases. So you can no longer take advantage of it on existing properties purchased after today. And you can take advantage of it for properties that are new builds. So new builds are exempt. And also, if you're already doing it, it's been grandfathered. So existing properties you owned before today, you can continue to negatively gear. Properties we buy from today that are existing dwellings cannot take advantage of negative gearing. And ultimately, to provide an example of what negative gearing is, so we rent a property out, we get $20,000 of rental income, say. Then we've got a mortgage on that, so we pay some interest expenses. On top of that, we pay rates, maintenance, and the like. And say our expenses come to $30,000. So we're running this property at a $10,000 loss because the income is less than the expenses. In the past, we've been able to claim the full $30,000 of expenses to help us reduce our personal tax at the end of the year. With new legislation, again, from today for existing purchases, that is no longer allowable. If we're earning, again, $20,000 in rent, our expenses are $30,000, we can only deduct $20,000 of expenses from our tax at the end of the year. So it doesn't allow us to negative gear and take advantage of the loss, basically, that we're making each year on our income. What you can do, however, or what was proposed, is that $10,000 above the income, we can carry that forward. So we can use what they call in carry forward losses. And again, it's a bit unclear whether we can take that off the cost base and help us reduce our capital gain, or whether we can use that in subsequent financial years and reduce our tax payable, again, without negative gearing. And that is solely for property. There's people out there that might be employing debt recycling strategies or gearing strategies. And again, nothing changes to those. Well, at least in the proposal, in the budget, it doesn't mention those specifically. It's all around property specific within that section. So if you're employing an existing strategy that's not property, like those debt recycling or gearing strategies, you should be able to continue on as is. The last tax reform that we'll go through today is the change to discretionary trusts and how they are taxed. So discretionary trusts or family trusts, and again, David and myself, David from Optimized Accounting, did an episode on family trusts and the benefits, and we chatted about how they're taxed and the like. So some of that is now redundant based off this new proposed legislation. Again, it hasn't been legislated, so it's just proposed. But what they're saying is from 1 July 2028, they're bringing in a 30% minimum tax rate on trust distributions. So what happens in the current format is all income from a discretionary trust or family trust gets distributed out to the beneficiaries say you and your partner, your partner and the children, maybe, whatever that looks like. And then they pay tax on those distributions at their marginal tax rate. Again, being able to claim the tax-free threshold if applicable. But with these proposed changes, they won't be able to claim that tax-free threshold anymore. There's actually a 30% minimum tax. And that tax, so the trust pays that tax, not the beneficiaries. So it gets taxed internally, so to speak, or the trustee gets taxed. And then when the funds are distributed, or when the income's distributed to the beneficiaries, they then declare it in their tax return. They get that 30% tax credit on it, so they don't have to pay that 30%. But then if their assessable income is higher than that 30% bracket, they'll pay the excess tax as required. So a bit of a change there again, not allowing you to claim the tax-free threshold. This only affects discretionary trusts or family trusts. It's not on, super or deceased estates or testamentary trusts. It's not on fixed trusts or charitable trusts. Again, the world of trusts, there's so many out there, and it can get confusing. But the most commonly used one we see is family trusts, and does affect this proposed change does affect those. There is what they're calling a rollover relief that is applicable for the next 3 years. Again, there hasn't been a lot of information provided around what that actually looks like, but there's a 3-year restructure out provision. So, what we might assume is that potentially we may be able to release the funds from the trust or change structures without the need to pay CGT or capital gains tax. But again, it's not very clear in the budget, so it's a bit thin on details. So maybe if that's a consideration, chat to your accountant. And obviously, if you do have a trust, this is going to affect you. So chat to your accountant, and they can help you decide or cipher through how this will all affect you. There's some benefits in there for small businesses with a $20,000 instant asset write-off, which is already in place. That's now been made permanent. And we had Alex Kutry from Auric in here. So startups, there is a bit of benefit in here for startups with a loss refundability scheme. So if you make a loss in the first 2 years, there's some benefits there that you can take advantage of later down the track if you do start to make a profit. There's been cost savings measures in there for, NDIS with some NDIS funding cut. There's, lots of different spendings in there, but, just focusing on the tax changes, those are the major ones that we covered off on today. So if you do have any questions on any of those, reach out to your accountant, or we can have a chat, to see whether your strategy is right for you at the moment. And if you did want to do that, again, feel free to visit our website, our Guidance Financial website, and you can book yourself in. You can book yourself in for a wealth builder appointment if need be, and we can help you, see how this affects you in your personal situation. But that's a wrap on today's episode. A bit of a different one, just with me and no other guest. But thanks for listening along. If you did like this episode, feel free to share it with someone or drop us a message. But until next time, I hope you have a good day.